If the markets fall 30%, 40%, I don't know how I would behave. But sadly, for that to happen, some people will lose their life savings. But I hope...
No. We are not suggesting that it is going to happen or we want that to happen.
If I had invested on January 8, 2008, I would have to wait for 6 years and 9 months to get my same money back.
If you had to retire tomorrow, what portfolio would you personally hold? What is the biggest mistake that people make when calculating their retirement corpus?
Every assumption can be made a mistake, right? I mean, you make an assumption on your years, inflation, return assumptions, everything. What people overestimate is most commonly how much Nifty 50 or Nifty would return. The market would graduate.
Basically, returns.
They overestimate how much that they can return, because based on our memory is from 2020 to 2025, and we are forming opinion based on that, right? I mean, expectations based on that. And that is extremely wrong. I mean, people who have lived through 2008 to 2012 know that 5-6 years I got kantas, literally zero, right? I mean, literally made zero money. If I had invested on January 8, 2008, I would have to wait for 6 years and 9 months to get my same money back. So, people who have not lived through that, I think now they are living through that. I think this last 2 years.
No, I feel this is different. It is different if market is not giving any returns compared to if you are down 20%, 30%, and then market stays that way, then it is going to test patience of a lot of people.
Absolutely.
Right? So I think most of the investors are still there because market is still between that 23, 22 to 2,500 range. Right? The day if it goes to 16,000, stays that way for 3 years, I don't think we'll have these many investors still.
That is true. That is true. For every person's own benefit, I hope, right? I mean, I'm not praying. I'm hoping that actually happens early in one's career. I'm not too late, because this is an inevitability with stock market. Right? At some part, you're going to sit at minus 30% portfolio and stay there for maybe a year. Because we have seen 2003, we have seen 2007, 2008. Before us, our parents have seen 1991, where elongated period of time, nobody made money. It is a good education to have on risk management, and people will realize what you're missing out when it hits that 16K or 17K, Nifty hits a 17K. But sadly, for that to happen, some people will lose their life savings. So I'm not praying that happens. But I hope...
No. We are not suggesting that it is going to happen or we want that to happen.
That will be a good education for a lot of people on what to expect from the markets.
On similar lines, let's say someone retires today, and in the first 5 years, the market crashes, inflation stays high, health expenses increase. Then what would a good retirement plan do in that situation?
So a good retirement plan should have done something before retiring. And that would have been to say that first 7 years. So 7 years is my assumption, right? I mean, it can differ for different people, and based on age, this can also change. First 5 years to 7 years of retirement, you would have had parked funds in a liquid or a short-term fund or a medium-term fund separately in your 3-bucket strategy. So I split life into 3 buckets. Then say first 5-7 years is here, second 7-8 years is here, and instruments are different. Asset allocation is taken in total, but buckets are different and their purpose is different. So life can still happen. My expense assumption would have been like 50,000, but the war came and it became 60,000. It happens, right? But I still have a buffer of kept for 5-7 years, and especially when this happens, You hope that growth in bucket 2 and bucket 3 would actually compensate for the initial thing. So the action to have been taken is not get a surprise that, I started retiring and I'm seeing that first 5 years I'm burning out my entire 25, 30%, 40% of my corpus. So market crashes, your bucket 3 might go down, but you're not worried because you're going to touch that bucket in another 7 to 8 to 10 years time. And that is what you should have actually done. And that is what a good plan will actually do.
I also made a 3-bucket strategy for my viewers. So in that also I took 7 years, but I wasn't very comfortable with 7 years, honestly speaking, but I was running with a constant of 1.7 crore, right? So I had to do the same thing within those 7 years. The reason I have that apprehension is, let's say the market is down 5 years. I'm talking about market is down. Market is not just same, right? So at the same level. Market is down 5 years. Then we are assuming that within 2 years, it is not only going to recover to the same levels, it is also going to give you the returns of the last 7 years that you had baked in your plan, right? So for example, if I have baked in 9% return, so I'm saying that 5 years market is down, and then within 2 years, not only it is going to give me, get it to the same level, it is also going to, anyway. You are a financial planner, you'll have to live with what is available. You can't say that, okay.
Absolutely.
10 years.
There is always limitations. And there is a reason why we make that assumption, because we have seen that again 2003, 2008. The markets have actually done that, right? I mean, COVID is the best example. We all lived through that. I mean, 3 months we were at minus 30%. Suddenly we are looking at 50% profit in 3 months.
From an investor's perspective, for them, the most recent crash is COVID. What they will be doing is they'll be looking at it, hey, market went 30%, and then look at the year return in 2021. The point is it recovered way too quickly.
Correct.
And many people would have started just before COVID or after COVID. So they would think that this is how markets behave.
That's sadly.
But as we talked earlier, that if market stays down for a considerable period of time, I remember Pattu saying this.
Absolutely.
I have great respect for that guy. And he said, if market tomorrow crashes 50%, I do not know how I am going to behave.
Correct. Very true.
Even with all of the wealth of knowledge that he has, he said that. And I kind of respect that a lot, because if you have to show that weakness to people and you're showing that for their benefit, which is great.
That is why we love him. Yeah.
I went back and looked at our plans right after that discussion. Would I be able to survive 5-7 years? Had to make some tweaks, but then now I'm happy.
This is the reason why I came up with that 7 number, is because Jan 2008, it took 6 years and 10 months for Nifty to come back to that same level. So, and then 1 year to give returns. So that is why I was saying 7 years. I mean, we can make a 10-year bucket, but then none of us will retire, right? I mean, we can. So we have to strike a balance. And that balance was that 7 years. And for certain people who are a little aged, then it became a 5 year. So, I mean, just wanted to add that perspective. And yes, plus one or all.
There is no perfect plan. And it can't be ever, right? It all depends on future, and future is uncertain. On that, the next question is, how do you bake in the uncertainty of future in your retirement plan other than this bucket strategy?
So what I always have is this 3 bucket is only for your living, right? It's only your living expenses. There are expenses outside that. You might think that all your goals are achieved. What about you want to gift your grandson something, grandkids something, granddaughter something. Diwali aayega, expenses aayega. So all those are not baked into that number which you gave up. That those don't exist there. There is a concept which I read somewhere on the internet. I don't know where I read it. I'm not able to find it anymore. It was way early in my career. The concept was called surprise cash flow laddering. Invest in financial products which give you some surprise cash some 20 years later, 30 years later. You put some money one time and you forget it. And then 26 years, 25 years, 23 years later, suddenly you get some 50K, 1 lakh, 2 lakhs. So it was a very interesting, I'm not in favor entirely of it, but it's a very great concept in the sense that having surprise cash flows baked into your plan in the future is a great way to mitigate these kind of risks. I wouldn't buy an insurance plan. That is not what I'm trying to sell here, right? Try to have something, a fixed deposit for a PPF is a great tool for that. You put in some money and then you forget it. And then 15 years later, suddenly you get some money, right? I mean, you get PPF. With PPF, sadly, you can only do 1.5 lakhs a month. But assume there are tools which are similar in nature.
I'm sure you have a asset allocation strategy.
Yeah.
What's the strongest argument against your own strategy? So maybe you can reveal your strategy first and then.
It is interesting because my next video is actually on that.
it is going to be a trailer there.
So actually it was challenging my assumption. So my strategy was always very simple. Start with 100 minus age as equity. If there are too many dependents, I reduce my percentage of equity, increase my percentage of debt. And if I have achieved certain, if there are certain goals which are imminent, then I again reduce my risk taking capability because there is going to be an outflow immediately from my portfolio. So I start with my asset allocation at 100 minus age, and then I add in factors. What are the other factors? My savings ratio, my loans which I have to service, how much credit I have, how many dependents I have, do I see any foreseen circumstances where I have to pay for my son's college education and so on, any goals which are there. Then I reduce the risk taking. So this is how I came up with it. It's a very simple risk profile based plan which I actually came up with. Right? This is, and at this moment plan said 65% equity, 25% debt, and the rest in gold. Right? So equity again, I split between international and Indian, and that is actually the assumption which I was trying to break. What I did was, we talked about it previously before the call. So my assumption was 60% Indian equities, 5% international equities, because I'm not very comfortable with all the risks which are there. You add a market risk, then the currency risk, and then on top of that, all these sanction risk and tweet risk and truth risk.
I love that.
So I am not able to handle so much of that. So I said only 5%. Right? That is that. So 60% Indian equities, 5% international equities, 25% bonds, including BFs, debt including BFs, and the last 10% in gold, 5-10% in gold. That is all I had. Right? I mean, this was my plan. Now, this is getting challenged. Because of the rupee depreciation, it is getting challenged big time. So there are two ways I can do about it. I mean, we touched about that. I mean, one is taking international position. The other is increasing my gold exposure from what I have. I'm going to take a balanced view on it. I'm heavy on India because I still strongly believe India will do well. But I'm going to take a balanced view, take a little bit more international exposure instead of 5%. I'm going to increase it to maybe 10-15%.
What do you think of China?
Yes. So it comes under the developed market. So I talked about my strategy where I said US, developed market without US and emerging market. So I am hoping every country in this world, every investable country in this world will be covered within this, and I will have exposure to that. Am I going to start betting on countries by doing analysis? No, I'm not going to do that. Because I don't think I have enough macro level knowledge to make prediction that this country is going to do better the next year. I don't do that. So I take exposure.
No, it is not.
And then
But it is not only about macro level information, it is also about the home country benefit. So, for example, if I am here in India, market doesn't perform for 3 years. I know what is happening here. Would also know what is happening with the companies.
Correct.
And that way, I'll be at least assured. I'll panic a little less.
Absolutely.
But somebody tells me what is happening in Niger, 2 months, if it doesn't perform, I'll be like, oh, what's wrong there? Those issues are there. I don't think people think about it a lot. But yes, you bring a valid point. So along with macro level knowledge, it is also about the behavior.
Absolutely.
aspect.
Absolutely. A great point. Great point. Absolutely.
If you had to retire tomorrow, what portfolio would you personally hold?
I have this 3-bucket strategy in front of me. Right? So when I talk about it, that is why I'm saying it. It would be 33% each. Given I am 48 years old, I'm hoping God doesn't keep me more than 21 years in this earth. I would have 33% in debt, 33% in balanced or hybrid funds, and 33% in equities. So out of the 33% in balanced, I would still have heavy equity exposure through aggressive hybrid funds and equity savings funds and so on. So this is what I would, if I had to have a thumb rule, which says tomorrow somebody puts me a gun on a head and says, what would be my allocation? On a thumb rule, this would be my allocation.
So I don't believe in thumb rules. Do you?
I don't. So ideally, I would like to put because thumb rules ignore, our basic behavior, right? It and the markets fall, you bought it up, right? If market falls, if Professor Pattu says he can't control his behavior, then I doubt I can as well. So if the markets fall 30%, 40%, I don't know how I would behave. So thumb rules are, I wouldn't be not very comfortable doing that. But there is a historical reason why I said this 33, right? There is a study which is done in US, which states that a 60% equity, 40% bond portfolio, it's anything over, or you can, if you have sufficient number, that can beat anything else. You can achieve most of the things if you have a 60-40 in US. So in US, 60 is possible. For us, we will have to actually kind of sit to it hybrids in between. So that is why I came up with that logic. I came up with that number.
Nicely put. And thanks a lot for joining Gopalakrishna.
Absolute pleasure, my friend.
Yeah, it was wonderful talking with you on camera and off camera as well. And the previous conversations that we had, that was great. And if there is anything that you would like to say to our viewers.
No, I wish them all very well. Stay invested, stay patient. Patience is a virtue. It is highly underrated, and I think that is the financial superpower on which wealth is built. I think patience is highly underrated. So yeah, wishing you all very well.
Thank you.
Thank you.